This is Mark with Right Line Trading, and this is our evening newsletter, which starts with this disclaimer. That all signals and trading opportunities that we provide are for educational and demonstration purposes only. Traders should understand that investing in the markets involves substantial risk, and it should be understood that a person can lose a substantial amount of money. Always carefully consider your financial position prior to trading and never risk more than you can afford to lose. Now, normally I project my my Thinkorswim platform, but today I'm projecting my my NinjaTrader 8 platform. What I want you to see specifically is that we use Bollinger Bands with a unique setting to help us trade, but not in a manner that anybody else uses them. Now, here's our 50 EMA, and here's our Bollinger Bands with a 1/2 standard deviation offset. When price sits inside this 1/2 standard deviation, we call price a 50 EMA hugger. And when that occurs, that's when there's very low volatility and normally low volume. This is the period of time when trading is extremely risky and likely to give you a loser. And you can see here how price just sits inside that zone. If a wick comes into it, that's considered trading in that zone. Then when you move above the Bollinger Band, that's when you start to see the market trend. So essentially, I can show you another example right here. There's the Bollinger Band. Price is just trading inside it, and we're not going to trade. Now we have obviously multiple other ways of defining a trend, and you can see background color, our correlative markets, or our quantitative analysis, our Bollinger momentum, all done on a multi-time frame basis. Also click in, but the Bollinger Bands are helpful. So we've defined market movement in this way. Let's say that this green line is our 50-period moving average. And it could be an EMA or an SMA. Does not make any difference. And this is 1/2 standard deviation off the 50. When price moves like this, it really obviously the market's in chop, and simply moving back and forth across the 50. Now eventually there's going to be a significant breakout, and after that move up, and we're going to pretend this is a big move up. You know, if we're trading the Forex market, it's 30, 40 pips. If we're trading futures market, it could be 75 or 80 ticks. If we're trading a stock, it's really dependent upon the price. It's a 5% to 10% move. Once this move is made, the market is going to then start moving in that same pattern. And then it's going to have a strong predisposition to want to retrace back to mean, which is that 50-period moving average. And we're not going to trade it up here. It could take another leg up, but more likely it's going to retrace back to the 50, and we're going to set ourselves up again for the same scenario right here. So we've defined price in a different way. Rising triangles, falling triangles, J-hook patterns, are all absolutely useless in a market that's governed by institutional money. When institutional money stands down, this is what the market's going to do. Small retail traders are just going to take the market a half standard deviation above and below mean price. Institutions are going to come in and they're going to whack price up. Whoops. Hard. Then they're going to stand aside, and small retail traders will again put price into this choppy sine wave type action, and will either get a leg up or more likely a retracement. That's the real way that price moves in today's market. I hope you got some good trading tips out of this, and I look forward to talking with you tomorrow.